Hi, I'm Grant Stevens.
And I'm Kris Bernier.
And we're the Two Investment Guys. This week, Kris and I want to talk a little bit more about some of the market dynamics. If we have a quick look around the globe at indice returns year to date, we see Toronto and the S&P 500 in the US down about 10% so far this year. If we turn to Europe, we see London down about 14%. France and Germany are down about 20%, and the major Asian markets are down about 15% each. So what we see in the markets now is an awful lot of turmoil and volatility around a good deal of financial data, Kris, that has turned negative, and it's also caused quite a bit of negative sentiment. Why don't we talk about why?
Sure. Well, one of the trigger points earlier this year was the Japanese earthquake and tsunami, and that caused supply disruptions, and that was believed to have been part of the reason for some of the slowing of economic data that we've seen the last couple of months. But it appears now that this may be sort of a precursor to slowing global growth, as we've seen a number of analyst and economist estimates ratcheted down to, sort of that barely growing 1.5% kind of area. Right. And that's caused a lot of negative sentiment in the markets.
Sure. So what we see is the global equity markets coming to grips with the fact that we're in a much slower growth environment than originally expected, and therefore, the valuations put on stocks and the cash flow that they generate has to come down. At least that's the thesis behind it. Mm-hmm. Now, we've seen this before where metrics for valuations on stocks do shift, but why don't we talk a little bit about what that shift might be at the moment?
Sure. Well, historically, price earnings multiples have been used to evaluate stocks. We saw during the 08-09 financial crisis where Canadian bank stocks, for instance, lost 50% of their value. The dividends weren't cut, but the price earnings multiples went to half of their historical averages, which, at the time, looking back, was a tremendous opportunity and represented great value. We're going in that same direction right now, despite the fact that we've seen dividend increases out of the banks over the last couple of years, which would suggest management is confident about their earnings going forward.
Right. I think, Kris, the global investor is having a great deal of difficulty wrapping their head around clarity on the degree of the slowdown and how much that affects the free cash flow in these companies that pay dividends, and thereby exasperating some of that negative sentiment. Mm-hmm. And I think it's important to consider that dividends are very important in the portfolio because they represent one of the new valuation metrics, at least in the moment of the market today, mm-hmm. and that's yield, and that's something we've talked about a lot. But yield does tend to support some of these stock valuations when you get in these scenarios of negative sentiment.
That's right. So if you look at the Canadian banks as an example again, you're looking at dividend yields in the 4 to 5% range based on current pricing. You compare that to 5-year GICs at 2.5%, that's a fairly wide difference.
Yeah. Kris, what eventually happens is markets do normalize, if there is such a thing as normal, and we'll revert back to sort of historical methods of evaluation, PE multiples being one of them. And that's the opportunity for people to pick through the market opportunities and, create a good deal of yield in their portfolio, which is critically important at the moment.
That's right, and we think the slow growth environment will be around for a while, so yield would be an important part of your returns going forward. Make sure you work with your advisor on how you can boost the yield in your overall portfolio. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at TwoInvestmentGuys.com.
Join us next time. We're going to continue our discussion around some of the things that we see in the market. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.